Alright, again in this video we want to construct a statement of cash flows. We want to see that cash flow from operations, financing, and investing all adds up to the total change in cash. So here we just have these balance sheets, and we see that the total cash flow was up $600. We do have two other bits of information. We're told that net income is equal to $1,800 and depreciation is equal to $1,600. Okay, so now can we go through and come up with the cash flow from operations, investing, financing? So cash flow from operations, we need to have net income, we need to have depreciation, we need to have a change in accounts receivable, change in inventory, change in accounts payable, change in accruals. That should all add up to be our cash flow from operations. We know net income we're given as $1,800, depreciation we're given as $1,600. Now let's look at accounts receivable. I covered that up. Look at accounts receivable and inventory, and we're also going to look at accounts payable and accruals. No, there's no notes payable on this. That's no big deal. You don't have to have notes payable. There's no law that says that. So that will make our financing part easier. So accounts receivable increased by $500 and inventory increased by $300. So is this a positive or negative cash flow? Accounts receivable is how much money I'm owed. I was owed $2,000. Now I'm owed $2,500. That's like somebody's borrowing money from me. So it's a negative cash flow for me. Inventory went up, so I bought more stuff, so that's a negative cash flow. Accounts payable went up by $1,100, so it's like I'm borrowing money from somebody else. That's the accounts receivable to the other person, right? I did owe $2,500, now I owe $3,600. That's a positive cash flow. Accruals, same thing. I owed $500, now I owe $1,000, so that's a positive cash flow. That winds up being positive $4,200. Next, we can look at cash flow from financing. I need the change in gross fixed assets, but I don't have that. I just have net fixed assets. Well, I know that gross fixed assets, or you could use the term plant, property, and equipment, whichever way you want to say it. Gross fixed assets minus accumulated depreciation is net fixed assets. I know in 2012 net fixed assets was $14,000. I know in 2013 net fixed assets was $14,800. I'm looking for the change in gross fixed assets, which I don't need to actually have this number. I can put a 0 here, 14,000, and accumulated depreciation went up by the amount of depreciation, 1,600. So that makes this 16,400, right? So this minus that is net. Gross minus accumulated is net. So the difference here is $2,400, and it increased, so it's going to be negative because I bought more stuff. Now I don't care if you don't believe me about putting a 0 here. All I'm looking is a change in this number and this number, right? So put in anything for accumulated depreciation for the first year, 2012, and the next year it's going to increase by $1,600, and it will work out every time to be that $2,400 number. And that's not cash flow from financing at all. It's cash flow from investing. Sorry, cash flow from investing. Cash flow from financing over here. I'm going to have change in notes payable, but there are no notes payable. So change in long-term debt, change in common stock, and this just has common stock in one big category. It's not split out into par and capital surplus, or sometimes called additional paid-in capital, and then subtract the dividends. Well, long-term debt and common stock did not change, so it's a 0. Need to figure out the dividends. With dividends, you have net income equal to $1,800, and retained earnings went from $2,800 to $3,400, so it's a $600 increase. So if I took $1,800 of net income and kept $600, I must have paid out as a dividend $1,200. Subtract that $1,200. That's my cash flow from financing. And so I add cash flow from ops, cash flow from investing, cash flow from financing together, and they add up to $600. Got it right.